Hi, it's Ross Waugh here from inframanage.com. Just a short video blog at the end of May 2020, and we've been talking in the last few video blogs about the effect of coronavirus pandemic and how that might impact on some of our infrastructure asset management decision making. I'm going to share with you on the screen behind me in the slide that's about low interest rates, and I came across this probably a couple of years ago in a paper I was reading, and I was quite interested in it because it goes right back to 1820, the graph, and it takes us right through to 2015, and what it's looking at is British and US long-term treasury or perpetual bonds. And what you can see there is that for a very long time, from 1820 right through to around about 1950, bonds in both countries were sort of in that 4 to 5% range. If you have done your reading or know your history, in around 1900 or a bit before that, when US railways were expanding all the transcontinental expansion, they were issuing 50 and 100-year bonds. And the reason they could do that was that the rates were so steady that there was no perceived risk at that time in taking such a long period. What happened after World War II, coming into the 1950s up to a peak in the sort of late 1960s, early 1970s, was that interest rates spiked. The cost of money got a lot higher, right up to sort of 15, 16, 17% in the US and the UK. And you stop and think, why was that after a period of such a long period of stability of rates? And it's simply this. You had a massive amount of rebuilding going on after World War II. It was a very, very destructive war. You had the Cold War, so you had geopolitical competition going on between two major powers and their satellites and their spheres of influence. And then you had the Middle East oil embargo coming in the early 70s and the shocks associated with that. Since then, the interest rates have fallen steadily right down to now as a result of COVID pandemic, near zero and below zero in the European zone. And the question is, and it's about your assumptions about the cost of doing things, what happens going forward. The author of this particular paper and this information was suggesting that maybe we should be looking the period 1820 to 1940 for the next perhaps 150 years that interest rates will be low. If that is the case, then it changes the calculation and it changes the math on whether you invest in infrastructure. If there is no penalty cost essentially for borrowing money, then you can, as we talked in the previous video blog, iron out the peaks and the troughs and set up a long-term investment program over 20, 30, 40 years, knowing that the cost of borrowing to do that isn't going to move around a lot. Now, we don't know what the future's going to bring. If you'd said back in November last year that the whole world would be locked down in a pandemic right now, you would have said, no, never going to happen. So things can happen change very quickly. But the cost of money and the cost of investing in infrastructure is a key component of your decision making for a 10, 20, 30, 50-year investment horizon. And I think it's good to have a look at what your assumptions are, how valid they might be, and whether in fact your assumptions could be changed, and whether long-term investment actually makes a lot of sense at the moment. So that's it for today. Just a little look at what interest rates might be for the next 10, 20, 30 years and how might that impact on your infrastructure investment program. Thanks for watching.